Hi everyone, greetings from Mexico. It's a holiday here for Benito Juarez, a major politician and president of the 19th century, century before last. So Mexican holiday, and we all need a holiday after the dreadful performance of the oils over the past couple of weeks. It was a brutal week last week particularly. And we think what's happening here is essentially you're moving into discounting deflation, hopefully not stagflation. In the oils. So essentially, if you remember, and it seems incredible now, but the Fed actually wanted inflation and stated they wanted inflation. And our response to that was, if the Fed wants inflation, they're going to get it, and that's going to be bullish for the oil. So that 2-year run that we had bullish was pretty easy, basically. And as Mohamed El-Erian, the famous strategist, said, effectively the Fed made the worst inflation call in history, and I think he's on the money with that one. So now we're into a deflation, disinflation, maybe stagflation. I don't think we'll see stagflation, basically because the US labor force is so much more flexible than it was in the 70s. In fact, EU the same. So back in the 70s, you had a lot of fixed wage adjustments on highly unionized workforce, and that's not the case anymore. And so I'm less worried about stagflation, but I can see a situation where we get into deflation, and that becomes bearish for oil demand, and that becomes bearish for the oils. So that's that. There are a couple of other major problems. One is the two elements of the big bull case that we were subscribing to this year, but worried because we said we don't like this because everyone's bullish and they were all using the same argument, was number one, that Russian exports of oil would fall, and number two, that China would come roaring back from COVID lockdown. And neither of those things are really working out. We haven't seen anything like the fall in Russian exports that was anticipated. If you recall, Novak, the energy minister, had said Russia would cut production and exports implicitly by 500,000 barrels a day in March. We're just not seeing that. So Russia didn't come in on the bullish side. Additionally, they're competing into Asia, which undermines Saudi's ability to control the market, because historically you've had an Asian premium for oil, essentially because Asia's dependent on the Middle East for the majority of its oil imports. Now you've got Russian barrels undercutting, and that becomes difficult for the Saudis to manage in terms of just holding the market together in the way they want to. We think the Saudis want $95 oil. It's just not very easy for them right now to get there, and they're not actually acting. Another actor that's not acting is the US government, where the administration has backed off what was thought to be the potential to increase the SPR at prices around where we are now. So once we got a 7 handle on oil, the idea was that you had a put from the US government which would rebuild the SPR. They have demurred, as we say, they've demurred on doing anything. So that's not happening. So the supply side's problematic. And then on the demand side, while China is coming back, it doesn't look that amazing from a crude import standpoint, and rather bearishly is also exporting quite a bit of product into Asian markets. So that didn't show up, and that's the problem, is that everyone was bullish, everyone had high expectations. We thought the oils were fair value when oil was noodling around $84 a barrel, and we thought you needed to move to 100 to make them work. And we got to move to, in exactly the opposite direction, and so it's been an absolute disaster. And at the moment, we're standing back and saying, we're not going to catch this falling knife. Let's let this thing find a floor. And at the moment, as always happens with oil, every headline you read is bearish, and we'll need something dramatic to turn that, but we're simply not getting it. For example, the weekly DOE data are just coming in neutral. There's no drama there. On the supply side, there's really nothing dramatic happening. And again, the first principle is always demand, and it just doesn't seem that it's super strong. So we're standing and watching. We've been highlighting Oxy. We highlighted it before this crisis. On Saturday, we sent you a note highlighting that all these private planes flying to Omaha, if you buy Oxy shares, you've already made the flight. A notorious flight, actually, back in the day when Oxy was in a real tangle taking over Anadarko. The flight was made to Omaha, but that's done and dusted. And in the note, we show you that on any weakness, Warren Buffett buys more of the stock, and that's obviously making it hugely defensive. So we're in a very defensive mode. Next thing to be bearish on would be refining. If you're worried about distillate, for example, you could easily worry about refining, which has held up brilliantly, as cracks have actually held up well. And that actually tells you that fundamentally the oil market's not that broken. It's just not as good and tight as we thought it would be coming into 2023. And at the time I was calling for $120 barrel oil by driving season. It'll be a miracle if we get there, based on what's happening with Russia and China, which were the two key bull arguments. We can see support from Saudi acting. We can see support maybe from the US administration acting. I kind of doubt they will. But in the meantime, it's just been brutal. And as I said, we're kind of standing out of the way at the moment, particularly if you were long service stocks. That's been an absolute disaster. All right, well, good luck out there. It's obviously a huge week with the Fed, and we'll see how we get on. All right, cheers.